Hey, welcome back, options traders. Well, I got a good question from one of the traders in our group asking about the spread delta. And apparently he had read this somewhere saying that you need to check the spread delta for this reason or that reason. And he was just asking, well, I've heard of delta, but what is a spread delta? Well, it's actually very easy. It's just the net delta for any type of spread position, but it can be confusing because traders often forget that it is the net position that matters. So let's go have a look at what is the spread delta and also why it can be confusing. So to do that, we have to start off with our basic definition of delta, which remember is one of our Greeks. It's an output from a pricing model. And delta simply shows the rate of change of your options price for a $1 move in the stock. That's a very basic definition. Technically, it should be for very small changes in the stock's price, but it's certainly good enough. So for instance, let's say that the stock is trading for 100 and you've got the $100 call trading for 5. You look at your broker's platform and it says that it has a delta of 0.6. And what this means, one interpretation, is that your options price is going to pick up 60% of that next dollar change in the stock's price. So if the stock rises to 101, it's picked up $1, your option is not going to go from 5 to 6. It's only going to pick up 60% of that dollar move and move to a price of about $5.60. So once you understand this, the spread delta, again, is simply the net delta of all of the options in that spread. So it doesn't really even matter what type of spread. It could even be a covered call, which I know most people don't consider that to be a spread, but it technically is. But for this demonstration, I'm just going to work with a vertical spread. But any type of multi-legged position you can think of as having a spread delta. But here's why it can be confusing. Let's say that we have a bell curve that, remember, is assumed to be sitting over the current stock price. So if the stock price is right here, let's say it's at 100, and let's say that we also have the 100 strike. So it's also lined up right here at the current stock price. Well, if we look at all of this area to the right of our strike, we're going to look at a call option. We could say that there is about a 50% chance for this option to be in the money. Okay, so this is where we start having value to our option at expiration if the stock is to the right side or to the high side of the strike for call options. So because this bell curve has half of the area filled in, we would say that the delta is 0.5. That's where that delta is coming from. If there's a 50% chance for this option to go in the money, then any potential gains should be multiplied by 50%, the probability of actually capturing those gains. But now let's say that the stock price moves $1 to the right. All right, so the center of the curve moves to the right one step, but our strike stays the same. So notice that the area that's been filled in increases. We've moved from blue to blue plus red. And this little additional area here in red is our gamma. It's showing us the additional deltas that we're picking up from that $1 move. So let's say that the stock price moves again $1 to the right. What happens? We start filling in more area to the right of our strike. Because remember, the strike price doesn't move. So now we've gone from the blue area being filled in to blue plus red, and now blue plus red plus green. So this additional area here in green is our new gamma. So the stock price moves another dollar to the right. What happens? Strike price stays the same, so we're moving that curve to the right of the strike. And we're just saying that we are absolutely just filling in more of this area, and therefore our delta is increasing. And so as the stock continues to move to the right, we're just filling in more and more of this area. So eventually, let's say that the stock continues to move far enough to the right, and we eventually fill in all of this area. Well, at that point, our strike is now, let's say, way out here. Remember, it used to be pointing to the center of the curve. And so at this point, what we're saying is that the curve has moved so far to the right. Remember that this is our current stock price right here. And right now we're saying that this curve is so far to the right, or that this option is so far in the money, that even if the stock price fell all the way down here to this left tail of the bell curve, a very low probability event, that this option would still be in the money. And at that point, we are delta 1. The entire curve is filled in. So that's where the delta is coming from. But let's now take a look at a vertical spread. Let's say that you buy the $100 call for 10, but you sell the 105 and maybe get $8.25. Well, that's going to be a net debit of $1.75. Now here's where traders get confused. Your $100 call that you bought does have a positive delta, but the 105 call that you sold has a negative delta. Why? Because everything is reversed when you sell an option. See, traders always assume that call options have positive delta. Well, that's not necessarily true. Long call options have positive delta. But if you sell the option, it flips. It's negative. Everything flips. If you buy the call, you had to spend money. It was a debit. But if you sell the call, you receive money. It's a credit. If you buy the call, you've got positive deltas. If you sell the call, you've got negative deltas. Everything is reversed. And so it's this second option here, the short one, with the negative deltas that's offsetting these positives. And that's why sometimes we refer to a spread delta. So here's the spread. Here's our long 100. There's our bend. There's our bend at 105. And here's our $1.75 price. This black curve is at expiration, but today we might look like this in blue. And as time goes on, what happens? The blue curve starts to move towards the black. So this blue curve might have 30 days, green curve might have 20 days. And then we come in a little bit closer. Maybe we've got 10 days until expiration, and then 5 days. And you see what's happening. These curves start getting closer and closer until they eventually land right on that black curve at expiration. But when you're talking about spread deltas, you're looking at the net for any of these curves. And it could actually even be for the expiration graph. It's just that those happen to be easy. The difficulty and the confusion comes in with the current curve. So let's say that the stock is way up here, maybe close to 115. Yes, your $100 call might have a plus 90 delta. And so this is where traders look and they say, I don't understand. My option that I bought has a very high delta. Why isn't the spread responding? Stock just went up a buck and this thing hardly moved. Well, that's because you also have the short 105 call. And it might have an 85 delta, but remember, to you, that's a negative. So if you have plus 90 deltas and minus 85, the 100-105 spread might only have a 5 delta. Now, of course, if the stock moves up really far this way, much further to the right, both options are now deeper in the money. Yes, you might see that your $100 call has a 100 delta, but your 105 call might also have a 100 delta, negative 100, and that means that the net between them is 0. And that's why this blue line, probably have to move out a little bit further to see it actually flatten out. But it's very easy to see at expiration that black curve is just dead flat. And that's because the net between those two deltas is 0. But now here's where it becomes even more confusing for traders. We just saw that we might have a 5 delta with the stock up in this range. But what if the stock is way down here? Let's say closer to 90. Now your $100 call might have a 30 delta. The 105 call might have a 25 delta. But the spread once again has a 5 delta. So think about that. The stock is way down here. Both options are far out of the money, and you've got a 5 delta. But when the stock was way up here around 115, you also had a 5 delta. But those are radically different positions. Down here is arguably a really bad position to be in because you're working towards maximum loss. You've got positive gamma down here. On this side of the graph, you've got negative gamma. You've got positive theta. You're working towards the maximum gain, even though you have 5 deltas in both cases. So this is why it's not only important to understand what a spread delta is, it's simply the net between these deltas, but this is also why it's important to understand your gamma and your theta. Because that way, just by looking at your broker's platform, you can tell if you are on the profitable side of the strategy or if you are on the losing side. It's not just about understanding the spread delta. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.